Okay, so you're welcome to this lecture. My name is Gideon, and I would like to take you through business finance, specifically capital budgeting or investment appraisal, right? So, and of course, that is a very critical or examinable area where we have to ensure that we pay attention because it is one of the key topics that can be examined. It's very highly, examined area, or aspect of business finance, or so far as finance is concerned, taking into consideration financial management, corporate finance, business finance, and then what have you. So that is a very critical area that we have to get some understanding into some of the terminologies that can aid us ensure that we embark on a very seamless, calculation or enhancement or understanding with respect to this topic, right? All right. So basically, when you talk about business finance, it's how businesses finance their operations, right? It's either they use the equity method or the debt method to finance their, business. So that is basically what it means. In simple terms, business finance is how businesses finance their operations to that effect. Now, that is basically a topic, as I indicated, under business finance, which is very crucial that we get better understanding because that is basically a topic that businesses, organizations don't overlook or belittle. Because so far as an organization is concerned, what it means is that they have to embark on what investment decisions. They have to embark on what invest project decisions, right? And for us to be able to make a sound project decision or informed project decision, then it means that we have to understand uh, this particular topic or this particular concept, capital budgeting or investment appraiser to that effect. And so that is what we are going to do in the next 1 hour. So, if time permits us, we can just look at some other aspects of it. But then let's try to do this together and let's see what happens into the foreseeable future, right? Okay, so basically, as I indicated, capital budgeting. Now, let me try to give an introduction to this particular topic. As I indicated, always it is very crucial so far as a business entity is concerned. There are times that you have to make decisions pertaining to some investment or projects that you want to embark on, right? And so, for instance, if you want to introduce a new product line, being it a manufacturing company, and then now we want to introduce a new product line, and now we are going to consider the initial outlay, that is the initial investments or the cost of investment. And then also after considering that particular aspect of that activity, we are going to also compare the cash inflows that is going to flow to the entity into the foreseeable future. So for instance, what you are going to do is that you're going to just oppose the cash inflows that is going to come to the organization and then also the initial outlay or the initial cost, right? And it is basically understandable, and that is the nature of every organization or business, that every business, the motive of every business, if you are not an NGO, then it means that you are in to make profits. And so you ensure that in all your activities, you would what minimize cost and then not maximize profit to that effect, right? So when it comes to capital budgeting, looking at the analogy that I gave, right? So basically, we are going to compare the cost of the investment, the initial outlay, and then also the cash inflows, right? So, for instance, if you're able to do that, comparison, and then realize that now the initial cost or the initial outlay or the cost of investment is actually greater than the revenues that you are going to generate at the end of every year, then it means that it is advisable that we ought turn down that particular investment or project, because at the end of the day, it's not going to help us. We are going to run at a loss at the end of the day when we decide to embark on that project, right? So it could be an equipment. Now we are into, manufacturing. Now we want to buy a new equipment. Probably we are into, let's say, mixed production, right? And for us to be able to do that, we would have to get some necessary equipment where we can be able to facilitate or promote a similar sort of productivity to that effect, right? So it means that we would have to buy new equipment, and in buying that new equipment, you would have to consider the cost and then also the cash inflow that is going to flow to us at the end of the day. Now, supposing that the equipment that we are going to buy or purchase, procure, is going to cost us 20,000 cedis, right? Now, we are looking at that cost, and then also any cash inflow that would come at the end of every year. So far as that particular machine is concerned, are you getting the point? So that is basically, these are some of the decisions that every organization would like to embark on. Now, capital budgeting is very crucial. And what it means is that you have to be able to understand how we can deploy the techniques. So far as capital budgeting or investment appraiser is concerned, we can deploy some of the techniques or the tools or the instruments which can aid us, make an informed decision. Please, are you together? So that is basically what we are doing. So the concept of capital budgeting, what does it mean? It is a financial technique used by organizations to assess, analyze, select a long-term investment project, right? So as I indicated, it is a financial technique. So here we are looking at the financial aspects. Are you getting the point? We are looking at the financial aspect of this particular project or investment that we want to embark on. And basically what we do is that there are three key activities that we perform, right? So the first one is what we assess. So there is an evaluation, there is an analysis, right? We embark on some analysis. Then after that, on the strength of the evaluation or the assessment or the analysis, then we select the viable projects. Now, what is viable project? When you talk about viability of a project, we are looking at a project that is very sound, financially sound. It means that if you are able to embark on that project, then the returns that we can get is going to be something that we are going to appreciate. So when we talk about viability of a project, we are looking at a project that is financially sound to that effect. So the three key activities that we undertake or we perform so far as capital budgeting is concerned is that we assess the project or the investment that we are going to embark on. Then at the end of the day, we analyze it, we select the best project. Because now you may have two projects, project A and then project B. Now deploying the techniques for capital budgeting, right? Probably project A is giving you this, project B is giving you this. So on the strength of that particular findings, then you have to be able to determine whether or not I'm going for project A or I'm going for project B, right? So it's very important that we embark on that particular decision. And of course, it's investment related. And of course, if it is investment, then it means that then there must be returns. There is no way an investor will invest and at the end of the day, the returns wouldn't be, nothing to write about. Of course, there must be something that would encourage or motivate him. And so every investor seeks to achieve a returns on the investment that he has made, right? So that is basically that. So we just look at the financial aspects of that investment. So these initiatives usually require large financial outlays and are anticipated to pay off over a number of years. Of course, it is not a short-term investment, as we said. It is a long-term investment, right? And it is basically capital intensive, right? What it means is that it requires or demands a very huge amount of money, right? And this huge amount of money is basically the initial outlay that we talked about. And then also, at the end of the day, if you're able to accept the project or buy that new equipment, purchase that introduce that new product line, then we are anticipating that at the end of the day, then you should be able to recoup or recover the investment cost or the initial outlay. Now, what are we saying here? What we are saying here is very simple. Now, if we are able to accept the project, taking into consideration the cost that we are going to incur, now over time, at the end of every year, probably we can give ourselves 5 years, 6 years, 7 years. It is a long-term investment that we are embarking on, right? So the money that we are going to generate in the foreseeable future should be able to recover that initial cost or the initial outlay. That is what we are saying. Are you getting it? So for example, buying equipment, as we talked about, constructing new facilities, introducing new goods, or investing in technology. So these are some of the examples that we can talk about so far as this particular lecture is concerned, right? Now, we talked about the fact that investment is a key player in this particular activity. And so what is investment? Investment is any expenditure in the expectation of future benefits. Of course, if you're an investor, you expect that you will get some more future benefits out of the investment that you've made, right? So that is the objective or the aim of every investor. I don't know if you're an investor and you don't expect anything, then I think there is something that is wrong, and we have to probe or investigate into that particular thing, because every investor is basically a return oriented. Are you getting it? He always expects that there will be a return on the investment that he has made. Are we good? So that is basically that. Now, what is expenditure? It is basically any cost incurred on something, right? And we have capital expenditure and revenue expenditure, right? So capital expenditure refers to the money spent on acquiring, improving, extending the life of long-term assets that will benefit the business for more than 1 year. Now, what we are saying is that expenditure has been grouped or categorized into two. We have capital expenditure and then what? Revenue expenditure. Now, when you take capital expenditure, we are saying that this expenditure is actually what? Incurred when we are acquiring, improving, extending the life of a long-term asset. And basically, what it means is that that particular extension or acquisition, or let's say procurement of that long-term asset, we anticipate that there will be a benefit of that particular asset for more than 1 year. Now, if that particular activity that we are embarking on will not have a lasting impact, a lasting benefit on the organization, then it means that it's not a long-term asset. Are you getting the point? So every long-term asset, I mean, other ways it could be non-current assets. That is basically, now that is the modernized way of, classifying assets, which have, a benefit on the organization for more than 1 year, right? So any asset that does not have a last benefit or a lasting benefit on the organization for more than 1 year, it means that it's not a non-current asset or a long-term asset. Are you together? So any expenditure or any cost that we are going to incur on what? Improving, acquiring, or procuring a long-term asset, it means that it is a capital expenditure, right? So what are some of the key features? Now, it's a long-term use. And then also it increases the value of a non-current asset, as I indicated. So now if you want to buy an asset, you are trying to increase the number of assets, non-current assets that you have in your business. Are you together? Not for day-to-day operations, of course. Capital expenditure is not for day-to-day expenses. We have the revenue expenditure who caters for that particular activity. And so when you talk about capital expenditure, it's not a day-to-day expenses. Please, are you together? Appears on the statement of financial position as an asset, precisely the non-current asset. So this particular item, it appears on the FP, that is a financial position, as an asset, precisely non-current assets. Are you together? All right, so that is basically that. What is revenue expenditure? Now, if it is capital expenditure spent on acquiring, extending the life of a long-term asset, then it means that this one is the opposite. So the revenue expenditure refers to money spent on day-to-day running of the business. And this costs maintain the business, but do not create long-term assets. So here, we are saying that the revenue expenditure, they are costs that we incur to run the organization. So it's a routine expenditure. Are you getting it? For instance, so the key features that we can talk about, the short-term use, it is basically a short-term, consume within 1 year. Realize that the first one was more than 1 year. So what it means that every capital expenditure should be spent on long-term assets, which is going to have a lasting benefit on the organization for more than 1 year. But every revenue expenditure, right, should have a lasting value within a year. That is what we are saying. Maintains existing assets. For instance, now you want to embark on some maintenance. We have motor vehicle, we have delivery van, and probably the engine or probably the, what is it called? The gearbox, whatsoever. Now you want to maintain it. So we are going to spend money, and that money that you're going to spend on that particular vehicle, it's going to classify as expenditure. That is precisely revenue expenditure. Necessary for daily operations, as we talked about, appears on the income statement as an expense. So that is basically the explanation or the understanding when it comes to revenue expenditure, right? Now, these things are very crucial. You have to be able to know them, even though it's very, very rare to be, asked in exams to define them. but then it's basically crucial for you to know them on your fingertips. It's going to help you. So that's why I've taken my time for us to go through the theory, so that when we are done, we can look at some calculations to that effect, because mostly they would ask you to calculate, deploy the techniques, the investment appraisal techniques towards embark on some financial decisions, investment decisions, and then all that. But then these ones are very important as well, right? Now let's look at a scenario. So scenario one, we are looking at opening a new restaurant branch, expansion decision. So that is about you trying to expand your restaurant, right? So we are saying that the Stevens Restaurant in Accra is considering an opening a new branch in East Legon. To decide, the management needs to determine whether the new branch will bring in enough profit to cover the cost of renting space, buying equipment, and hiring hot staff. Are you together? So basically, we want to open a new branch, okay? We already have an existing branches. Now we want to enter into East Legon market. Now, in doing that, what it means is that we have to rent a space for that activity. We have to buy equipment for that activity. Of course, you have to recruit employees or staff. And these are some of the initial costs, initial outlays, or the cost of investment that we are going to incur. Definitely, these things must be incurred. We cannot do away with these things. In order for us to be able to operate that new branch, it means that we have to incur these expenditures. Okay. So now, what is the capital budgeting application over here? Now let's take, for instance, the initial outlay of the business, or probably the new branch that we want to set up, is 500,000. So it's going to take us 500,000 Ghana cedis to set up that new branch at East Legon. Now let's take, for instance, upon deploying the what is it called, the capital budgeting techniques, we are saying that at the end of every year we are going to generate 150,000 cedis. So the cash inflow per year is going to be what? 150,000 Ghana cedis for the next 10 years. 150 Ghana cedis for the next 10 years. Now, depending on the NPV or the technical tools that you are going to use, so far as this particular course is concerned, that is the techniques, the investment appraisal techniques or the capital budgeting techniques. Is either, I don't want to go there because we are going to talk about it extensively, right? So it could be NPV, internal rate of return, discounted payback period. So these are some of the techniques that we can deploy. So now, looking at the profits that the organization, when they decide to open that branch, looking at the profits per year, you are going to get 150,000 for the next 10 years. Now, the setup cost or the initial investment is what? 500,000. So it will interest you to know that every organization would like to accept this project, would like to expand this business, because looking at the profit that the organization is going to earn at the end of every year, it is very, very, very beneficial. There is a sound financial decision. And so every investor would like to buy into this idea. So that is basically what we are talking about. Of course, when we start with the deployment of the techniques, we are going to do some analysis, some decision rules. So when the NPV is positive, then it means that we have to accept the project. And in accepting the project, it means that we have to open the branch. But when the NPV is negative, we are going to cancel or reject the project, because looking at the cost and then the income that we are going to receive, the cost outweighs the income. So when we decide to do that, we are going to run at a loss, right? So I think we are going to talk extensively, as I indicated, about this. So there is scenario 2, replacing old machine, right? So now you want to replace a machine. So a manufacturing company in Tema uses an old machine that frequently breaks down. They consider replacing it with a modern machine. And what is the capital budgeting application? Old machine repair cost is 80,000 per year. So now when you try to maintain the old machine that we have, we are going to incur 80,000 per year. Every year, it means that we're going to spend 80,000 cedis on that old machine. Now, when we decide to buy a new machine, which is 400,000 cedis, we'll reduce repair cost to 10,000 per year. Are you getting the point? Now, for the next 5 years, if you're a rational investor, what are you going to do? What are you going to do? Now realize that when we decide to buy the new machine, which is the 400,000 cities, and comparing that to the old machine for the next 5 years, what is going to happen is that we are going to be able to reduce what repair cost to 10,000 Ghana cedis per year. So it means that it's very important that what we purchase the new machine. Are you getting the point? It's very important that we purchase the new machine to that effect, right? So let's continue. Now, capital budgeting techniques or investment appraisal techniques, as I indicated. Now, what are capital budgeting techniques? They are the methods or tools organizations use to evaluate, compare, and select long-term investments or projects. So, as I indicated, basically, they are methods, okay? They are tools, instruments. They are methodologies that organizations will deploy. They evaluate, use those tools to evaluate, assess, and then also what? Compare, select a long-term investment project. Or we can say that capital budgeting techniques are decision-making method used to assess whether long-term investment will generate enough future returns to justify their cost. Of course, as I indicated, if you're an investor, you are always anticipating that there will be what? A return. So now the investment that we want to embark on, now there is the cost. Now, when we embark on that project or that investment, can we be able to generate enough money to recoup or recover the initial cost or the initial outlay, the initial investment? Then if we can do that, then it means that it's a very good project that we have to accept. This is very good. So that is basically that. Now, these techniques have been divided into two categories. We have the non-discounted cash flow methods, and then we have the discounted cash flow methods. Okay, it has been grouped into two. We have the non-discounted cash flow method, and then we have the discounted cash flow method. Now, when you take the non-discounted cash flow method, we are saying that they are cash flows methods that are used to evaluate investment projects using raw cash inflows without adjusting for time value of money. Hallelujah. And you'd have to respond, amen. That is fantastic. So basically, when you talk about non-discounted cash flow, we are saying that these methods, organizations deploy these methods to evaluate investment projects using the raw cash inflows without adjusting for time value of money. Now, let me try to go a bit into time value of money. Okay, it is a concept that we are going to look at it on its own, right? So when you talk about time value of money, we are saying that 1 Ghana cedi today is much better than 1 Ghana cedi tomorrow. Why? Because there are some factors. And so if I have 1 Ghana cedi today, I can invest it and get some returns on it. Okay. Now 1 Ghana cedi today is much better than what? 2 cedis next week due to inflation. Now supposing that you have 1 Ghana cedi today, you can buy what is the name? Alewa. Alewa 1 cedi. And I promise you that I'm going to give you 2 cedis next week. Now, anything at all can happen because we are not managers or controllers of the macro economy. So, of course, inflation can just come in at any particular point in time within this space. And so, the 2 cedis that I've promised you next week, it could be that within this week, prices of Alewa could go high. And what is going to happen is that probably that 2 cedis will not be enough for you to buy the Alewa that can be bought today using the 1 Ghana cedi. So that is basically the concept of time value of money. Are you getting the point? So we are saying that non-discounted cash flow method, organizations deploy them to evaluate investment projects using the raw cash inflow. What is the raw cash inflow? Now, don't forget that if you are an investor and you are making a decision, investment decision, right? You are anticipating that at the end of the year, you are going to get this. At the end of the second year, you're going to get this. At the end of the third year, you're going to get this. So all the incomes or the revenues that we are going to generate, it is in future. They are futuristic. Are you getting it? You haven't received them. So you are anticipating that you get that. So in making decision, financial decision or investment decision, now if you want to determine the real value of that particular amount that you're going to receive at the end of every year, then it means that we have to discount it. What are we doing by discounting? You want to determine that amount that you're going to receive at the end of every year. What is the value of those amounts in this present terms or today? What will be the value of that 10,000 cedis that you're going to receive at the end of year one today? What will be the 12,000 Ghana cedis that you're going to receive at the end of year two today? And so that is discounting. And so in simple terms, when you talk about discounting, we are trying to move money backwards to determine its present value. So that is what we are saying. But when it comes to non-discounted cash flow, they don't take into consideration time value of money. They don't discount. They evaluate project based on the raw cash inflows. So the future, inflows, the future incomes or the future revenues that would flow to the entity. They base on that to make a decision. But beloved, it's very bad. It is not accurate. As we go forward, we are going to explain that. Okay? Yes, so don't worry about it. You're going to get everything. Now, techniques of non-discounted cash flow, payback period, accounting rate of return. So these are the two techniques that we can deploy to evaluate a project, payback period. Of course, as the name goes, payback period simply means that, okay, so now we want to buy a new equipment, and that equipment is 500,000 Ghana cedis. How many years will it take us to recover or pay back or recoup that particular investment cost? Let me take it again. The payback, as the name goes, payback. How many years, how many months will it take us to be able to pay back the cost, pay back the initial cost, pay back the initial outlay? What is the period? It's going to take us 3 years. It's going to take us 4 years. It's going to take us 3 years, 5 years. 3 years, 3 months. It's going to take us 4 years. 5 months. We don't know. Are you getting the point? So this is going to help us, calculate for the payback period. Now, for your information, if the payback period is shorter, then it means that it's a good project. But if it is longer, it's not a good project. So it means that you have to reject it. Now, what is the interpretation over here? At the end of the day, if you calculate for the payback and then you are able to pay your initial investment, let's say at the end of the second year or at the end of the first year, it means that it's a good project. Because realize that at the end of the first year, you are able to pay back the initial cost. So what it means is that following the next year, which is the second year, the third year, the fourth year, all the revenues that you are going to generate is going to be a profit for you. Because now you have been able to pay off the initial outlay or the initial cost. So the subsequent years, the revenues that you are going to generate will be a profit. So the shorter the payback period, the more viable the investment is. Are you getting the point? So that is basically the accounting rate of return. Sometimes you can also use the return on capital employed, right? So that is another method that we can deploy. So the accounting rate of return, we are saying that we're just going to take into consideration the profit before interest and the tax. Are you getting the point? Then we try to do some computation. Now, if we are getting a lower, then it means that the project is not a good project. Are you getting the point? So these are some of the techniques that we deploy in ensuring that we get a good financially sound investment decision or informed decision. Now, why companies still use it? Companies do use this particular technique because it's very easy to calculate, good for quick decisions, helpful for small and short-term projects. Limitation, it ignores value of money, that is time value of money. Less accurate for long-term investment, may lead to poor decisions, of course. May lead to poor decisions because looking at the fact that you are trying to capitalize on, the cash inflows, which is not realistic. Anything at all can happen, inflation can happen. And so that particular inflow that you are saying that you want to use that as a basis to make a decision. Inflation can just come at any particular point in time. As I indicated earlier, we are not managers or controllers, supervisors of the macroeconomy. It is beyond our jurisdiction. Are you getting the point? So we have to take all these things into consideration, right? For instance, interest rate like this, it can go up at any particular point in time, right? So that is basically now that is that when it comes to NDCF, that is non-discounted cash flow. Now let's go to the DCF, discounted cash flow. So the discounted cash flow refers to a method of evaluating future cash inflows by converting them into their present value. And so here we don't use the raw cash inflow, but then we convert the raw cash inflows into today's terms. We determine the present value of the revenues that we are going to generate at the end of every year, so that we can know the real value of every amount at the end of the year. Are you getting it? So here, it recognizes the money today is worth more than money in the future due to inflation rates and time value of money. So as I indicated, it is more accurate. It's more accurate. So here we take into consideration that inflation can happen. Risks. It could be that there's going to be a COVID-19, okay, fire outbreak, okay, like anything at all, anything, risks can happen to you. And when that finds expression, then it means that there is a high tendency of you losing your investment. Are we together? So techniques, we have the net present value, the internal rate of return, discounted payback period, profitability index. So these are some of the techniques that we have under discounted cash flow, right? Why discounting is important? Because it accounts for inflation, risks, and uncertainty, right? So opportunity cost of capital, that is the cost of capital, changing value of money over time. Of course, we are saying that inflation, due to inflation, we want to determine the present value of that amount that we are going to receive at the end of year one today, so that we can know the value of that amount today. Due to risks and an uncertainty, you have to determine that amount, the present value of that amount they are going to receive for the subsequent years today, and know the real value of that amount. Are you together? So that is basically that. Now let's look at some of the characteristics so far as discounted cash flow and the non-discounted cash flow is concerned. Now, time value of money, looking at the factor called time value of money. Now, under discounted cash flow, it considers time value of money, but non-discounted cash flow ignores time value of money. When it comes to accuracy, it is highly accurate when it comes to the discounted cash flow. So because it caters for time value of money, inflation, and then risks, it's very, 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 very accurate. But then when it comes to non-discounted cash flow, it is low. It's between low and then medium. Are you getting the point? Useful for long-term projects, of course. Discounted cash flow, they are used for what? Long-term projects. And when it comes to non-discounted cash flow, they are used for short-term projects or simple projects. Now, examples. So these are some of the techniques that I talked about. NPV, that's the net present value, internal rate of return, and then you also have the discounted payback period and the profitability index. You have the payback and the non-discounted. So please, you have to pay attention. You have discounted payback period and then payback, okay? And we have the accounting rate of return. Focus, present value of future cash, raw future cash inflows. So that is basically that. Now let's continue. Hope you understand. All right, so non-discounted payback period, what is it? It refers to the period in which the project will generate the necessary cash to recover or recoup the initial investment or outlay. So I think you've actually mentioned it already. So it refers to the period in which the project will generate the necessary cash to recover or recoup the initial investment, the initial cost, or the initial outlay. So for instance, if it's going to take us 3 years, then it means that that third year becomes our payback period. And so it took us 3 years for us to be able to generate the necessary cash to recover the initial outlay. That is the interpretation. Are you getting it? Now, what is the decision criteria? The length of maximum acceptable payback period is actually determined by management. Okay? But then it also hinges on the fact that if the payback period is shorter, then it means that it's a viable project that we can accept. Because at the end of the day, as I indicated, the subsequent ones would be a profit for you, right? Now, the next item is that if the payback period is less than the maximum acceptable payback period, accept the project, right? So that is talking about the fact that if it is shorter, if the payback period is greater than the maximum acceptable payback period, reject the project. So depending on the decision that management is going to take, that okay, I think this project by the fifth year, you should be able to recoup, generate the necessary cash to be able to recover. Now, what we are saying is that, explaining the point two, if you're able to recover or generate that necessary cash to be able to recoup that initial outlay within the third year, then it means that it's something that we have to accept the project. Are you getting the point? Now, on the other flip, if you're able to recover based on the decision that management has made, that by the end of the fifth year, you should be able to pay this or pay off the initial investment, and we are not able to do that, looking at the analysis or evaluation, we are not able to do that, then it means that it shouldn't be, a project that we can accept or we should accept. We shouldn't want to accept that particular project because now it is actually beyond the decision or the boundaries of management. Because looking at the timeline that they set that they are going to pay back that particular initial outlay supersedes, that particular boundary. And so for that matter, we cannot accept the project. So that is what it means. Okay. So I think there is an example here that we can consider, which is very, very simple. Let's try to consider this example so that we can have a glimpse of whatever thing that we are doing. So please, it's very important to understand some of these issues. And so that's why I've taken my time. We go through together, okay? So that you can appreciate this particular concept very well. And so in conclusion, what we are saying about capital budgeting or investment appraiser is that it helps for us to make a good decision, okay? It helps us to make a good decision, financially sound investment decisions, right? So that is what we are saying. Okay, so beloved, let's look at this particular example. Don't forget that we are looking at non-discounted payback period. And there is a practical example that we are going to solve together, okay? All right, so example one. If a project requires 20,000 as initial investment, in other words, this particular amount is the initial cost or the investment cost, right? Now we are saying that if a project demands 20,000 as initial investment or the initial outlay, it will generate an annual cash flow as presented below for 5 years. What will be the payback period? So here, our requirement is that you want to ascertain or find out the payback period. How many years is it going to take us for us to pay back, recoup that 20,000 that we invested? These are together. So now year one, at the end of year one, this particular investment is going to generate a total income of 6,000. At the end of year two, it's going to be 8,000. At the end of year three, it's going to be 5,000. And then year four, year five, 4,000, right? Now there is uneven cash flow, right? We have even cash flow or equal cash flow or unequal cash flow, right? So let me explain that. When you talk about equal cash flow, we are saying that the amount that you are going to receive for year one is going to be the same thing for the subsequent years. For instance, if at the end of the year one we are receiving 6,000, it means that it's going to be 6,000 throughout the number of years. So year one, 6,000, year two, 6,000, year three, 6,000. That is even cash flows or equal cash flows, right? But then when you talk about uneven cash flow, we are saying that the amount that you are going to receive for year one is going to be a different amount for the subsequent years. Okay, so the amount will change. There's going to be a variation in the amount for the subsequent years. That is what we mean by unequal cash flow or uneven cash flow. Please, are you together? All right, so now year one, we're going to reach 6,000 as I indicated. Now let's go to our Excel so that we can just make some essence out of this particular question. So basically, the formula for calculating for the payback period is initial investment over annual cash inflow. Okay, initial investment over what? Annual cash inflow. Now, let's try to do something here. Now, don't forget that the initial outlay or the initial cost was 20,000. Now, we are interested in the period where you'll be able to pay that 20,000, pay off that particular cost. Now, so what you are going to do is that we are going to cumulatively add the numbers, the cash inflows. So this is 6,000 for year one. Now, year two is going to be what? 8,000. Now, 6 plus 8 is going to be 14. No, we haven't still gotten to 20,000. We still have about 6,000 more. Now, the third year is giving us 5,000, which when we add to the 14 is going to be 19,000. 19,000 is not up to 20,000. So it means that even though we are getting 19,000 at the third year, but it is not the period. But you realize that the next item is 4,000. So when we add 4,000 to 19, we are going to get 23,000. So it means that we are going to pay, the payback period is going to be between what? The third year and then the fourth year. Please, are you together? The payback period is going to be between the third year and then the fourth year. Let me take that again. Now, we've actually made an investment. I mean, basically, you want to embark on an investment or a project, and that project would demand 20,000 Ghana cedis. Okay, and the question says we should what? Calculate for, what is the name? We should calculate for the payback period for the next 5 years. Are you together? Now, these are the inflows that you are going to receive from year 1 to year 5. Now, we are saying that looking at the total cost or the total cost of investment, it is 20,000. Now, for year 1, this particular investment, when we decide to embark on it, we are going to get 6,000. Year 2 is what? 8,000. Year 3 is 5,000. Year 4 is what? 4,000. Year 5 is what? 4,000. Now, we are going to cumulatively add the numbers. So when we add the 2, 6 plus 8 is what? 14. 14 plus 5,000 is 19. And then realize that here 19 is not the same thing as 20. So you have to go to the next year, which is 4,000. And when you add 4,000 to 19, it is 23. So it means that the payback period is between the third year and then the fourth year. Please, are you together? So what is going to happen is that anytime you get to this side of this portion, and the payback period is between the payback period is between 2 years. I mean, what I mean by 2 years is if it is between the third year and then the fourth year, the fifth year, and then the sixth year. That is what I mean by 2 years. Now, what we are going to do is that you have to take the difference. Okay, the difference. Now, what am I saying? Okay, so let me practically represent this. So this was the initial cost. So initial cost of the investment. Initial cost of the investment was giving us 20,000. Now, after summing up, you realize that when we go to the third year, it is 19,000. So what it means is that we have 1,000 cedis left. Okay, and that 1,000 cedis can be found in the fourth year's what? Cash inflow. Please, you understand that? Because now we are looking at 20,000, but the third year is giving us what? 19,000. So when we take out 19,000, so the cumulative is 19,000. Now, if we want to find the difference, so it's going to be sorry. So the difference is going to be 1,000 cedis. The difference is going to be 1,000 cedis. And this 1,000 cedis that we are talking about, this 1,000 cedis can be found in the fourth year's what? Cash inflow. Please, are you together? It can be found in the fourth year's cash inflow, which is the 4,000. So now that is the interpretation. Now, anytime you get to this side, we are going to take the difference, which is the 1,000 cedis, divided by, and so here, don't forget that the payback period is between the third year. So it means that it is 3 years. So we are going to use 3 years and some months, because don't forget that 1,000 cedis does not cover for all the, the years that we have in the fourth year. Because now the fourth year amount is 4,000, but then we are looking at 1,000 Ghana cedis from that particular amount. So it means that that figure that you see is not a representation or full representation of what we are looking for to add up. So it means that we cannot take the 4,000 cedis, or you cannot say that, okay, so we are going to be, we are going to pay back the investment or recoup the investment in the fourth year. No, we cannot do that. Realize that we only need 1,000 Ghana cedis to add up. So it means that we have to split it out. Are you getting the point? So it means that now it's going to be 3 years plus the value that we are going to get here. Okay. So now 1,000 divided by 4,000. It is 0.25, 0.25, 0.25. So now what is going to happen is that the value that we are getting for 1,000 divided by 4,000 was 0.25. Are you getting the point? So now the payback period is going to be 3 plus what? Plus 0.5, 0.25. Okay. So in other words, the payback period is 3 years, 2.5 years, or let's say 3.25 years. Yeah, that is how we are going to pronounce it. Okay, 3.25 years. Or we have another step. We can decide to multiply the 0.25 by 12 so that we can leave it in months. So in that regard, you are going to say that 3 years, so and so months. Are you getting it? So now let's do that. Let's multiply 12, which is 12 months, times what? 0.25. It is 3. Are you getting it? It is 3. So it means that, so you can just say, or 3 years 3 years, 3 months. So that is what it means. That is what it means, right? So it's either we say 3.25 years or 3 years, 3 months. And how do you get the months? You multiply the 0.25 by 12, and you're going to get 3, and that should give you what? 3 months. So now we are going to pay back, recoup, recover that initial investment in the 3rd year, but not on the 3rd year exactly. But it's going to take us 3 years, 3 months to pay back that particular cost that we incurred in carrying out that particular investment. Please, are you together? So that is what it means. It's very, very simple. It's very, very simple. So I wrote here that from the table above, realize that 19,000 is covered or recouped in 3 years, but the initial investment is 20,000. So it means 1,000 is left out of the initial investment. Are you getting the point? Now the cash inflow in 4th year is 4,000, which indicates that payback period is between or is in between 3rd and then 4th year. So now it's going to be 3 plus 100,000 cedis divided by 4,000, which is going to be 3.2 years or 3 years, 3 months. So that is that. So that is what it means. That is what it means. So hope the understanding is okay. I think they gave you guys an example. This is a practice question that you guys were given, right? And I advise you to, as much as you can, you solve the practice question, because these things that you see here can come in the MCQs, right? Of course, your examination is going to be structured in a way that you're going to have MCQs and then also written. And so don't joke with the MCQs, because if you're able to get everything right, it will give you a very good grade to that effect. So don't belittle it that MCQs there to be ready. I can just do a friend saying, I will try my luck and I will just get everything right. You are joking. So that is not done. Okay. So you have to study the thing. You have to, believe that you know. You have to yourself, you have to be convinced. Convince yourself that you know. Okay. All right. So now let's look at the practice question. Project Alpha. On the first one, initial investment. We are still looking at payback period. That is non-discounted payback period. Okay. Now, initial investment is 120,000, and then the annual cash inflow is what? 24,000. Calculate the payback period. Now, this is a very simple exercise. A very simple exercise. So here, we just take the so let me do this. So practice question. Now, the question 1 says that the initial investment or the initial outlay it is, let me confirm, 120,000, and then the annual cash flow is 24,000. Okay. So this is 120,000. And then the annual cash flow is 24,000. So these are the two things that we have, right? Okay, so the question says you should calculate for what is the name? The payback period. What will be the payback period? And this is very simple. Now, look, this is our formula. We just copy the formula. So the formula is going to be the initial investment or the cost, the initial cost divided by the annual cash flow. So what is the initial investment? Now the initial investment is 120,000. Oh, sorry. It's 120,000. And then the annual cash flow is 24,000. Right. So basically, we just want to determine the payback period for that particular activity. Okay. So now we have the initial investment, which is 120,000, and dividing the annual cash flow of what? 24,000. Right. So the payback period. So we are getting 5. So 120,000 divided by 24,000 is 5. So it means that it's going to take us 5 years to be able to it's going to take us 5 years to be able to what? Pay back the initial cost. It's going to take us 5 years to be able to pay back the initial cost. So please, that is it. It's a very simple exercise, right? So let's look at the question 2. Let's look at the question 2. Practice question 2. Okay. So project beta, that is on equal cash flow. And I indicated that when it comes to an equal cash flow, we are saying that the amount that you're going to receive is not going to be the same thing for the subsequent years. So supposing if you receive 30,000 for the first year, there's going to be a variation to the foreseeable future. And so that is what we see here, right? Yeah. And what do you have here? This is possible to 1 want to paste this. Give me the options. Okay, so let's try to copy. So project beta. We have the initial, okay, we have the initial investment. Which is 80,000 cedis. So you have the year, because year one is the first year to be taken into consideration. And so let's say this is the column for the cash inflow that you are going to receive for every year, right? Okay, so it's supposed to be year one. So year one, year two, year three, year four, year five. Okay, it's just year four. Right. So year one is 20,000 Ghana cedis. Year two is 25,000 Ghana cedis. Year three is 30,000 Ghana cedis. And then also year four is 35,000 Ghana cedis. All right. So now you should determine the payback period. That is a requirement of the question. So you have to determine the payback period to that effect. Okay. All right. So now you know our formula. Let's go to our formula here. So let me write solution. Okay. Now looking at the initial investment, it is 80,000. Right. So let's add our cumulative column. So there is going to be this is going to be 20,000. We add this, you're going to have 45,000. Should give us 75,000. 110,000. Okay. So basically, the year one is 20,000. Year one is 20,000. 25 plus 20 is going to be 45. 30 plus 45 is going to be 75. Then 35 plus 75 is going to be 110. 110, right? So that is that. So now we are looking at 80,000. Okay. Visualize that when you get to the third year, we have 75,000, but our initial cost is what? 80,000. Okay. So the same idea. Realize that when we come to the fourth year, we have 35,000. So it means that the 5,000 that is left is embedded in the fourth year. So the same idea as the first one. So here, our payback period. So first of all, we can find the difference. So of course, the difference is going to be 5,000. Oh, sorry. So 80,000 rather. And the cumulative. $75,000. So now the difference will be 5,000. So now the difference is going to be 5,000. So now what it means is that so the 5,000 is basically what? What is left out of the initial investment? Are you getting the point? What is left out of the initial investment? What is left out of the initial investment? Okay, so that is what we are going to look at. So in order for us to get the actual payback period, then it means that we have to what? Find the 5,000 on the remaining. That is the 5,000 on the what? On the 35. That is the 4 years amount. So let's copy our formula. So of course, we are going to pay or recoup the investment the third year, but then it's not just the third year, it is the third year and some months. And so we are trying to get the right month, the actual months. Are you getting it? So it's going to be the third year plus what we are going to do right now. Okay. So 5,000 divided by 35,000. So 5,000 divided by 35,000. That should give us 0.14. 0.14. 0.14. And so it means that we're going to have 0.14, right? 0.14. So which can be translated as 3.14 years. Or you can multiply this by 12 to get it in months. Or 3 years, let's say 2 months. Because when you multiply the 0.14 by 12, we're going to have 1.7. So let's approximate it, okay, to the nearest whole number. So 3 years, 2 months. So it's going to be what? 3 years, 2 months. So it's going to take us 3 years, 2 months to recoup or pay back the 80,000 Ghana cedis. So beloved, I think that is very, very simple, and you should not have a problem. I mean, you shouldn't have a problem when it comes to the payback. But this one is the simplest, because this one we don't discount, you don't do anything. We just take the raw cash inflows, you just apply, you do the cumulative, then at the end of the day, that's all. These are you together. So that is this. All right. So let's look at the next question. So I'm going to solve this last question, and I think the rest with the understanding that we've actually gained. I mean, you should be fine. You should be fine, because I think all the questions are very simple that you can solve on your own, right? But basically, I think all the questions are the same thing. So of course, I think you can just go through this. So I solved the first one and then the second one. So the second one is the same thing as what? Of course, Project Delta, payback within the year. Okay. Calculate the payback period, machinery replacement, cost of machine, because you have the initial cost, that is the same thing as the initial investment. You have the expected cash inflows. So that is basically that. That is basically that. All right, so I think we would have to end here, and we are going to continue with accounting rate of return, which is going to be our next lecture, right? Accounting rate of return, which is basically under the non-discounted cash flow. So now we've looked at payback period, which is very simple, and our next, lecture is going to cover accounting rate of return, okay? And then after that, we would try and then cover some crucial topics as well, or crucial sub-topics, taking into consideration the discounted cash flow. So now when we look at the accounting rate of return, which is actually the non-discounted cash flow, then we would actually look at what? The discounted cash flow, which we are going to have the NPV, the internal rate of return, the discounted payback period. Now this one is discounted payback period, the profitability index, and then so on, right? So our next lecture is going to cover what? Accounting rate of return. Then we are going to add the discounted cash flow as well, where we are going to look at the NPV, the internal rate of return, the profitability index, the discounted payback period. So all the best, and I wish you well. Bye-bye.